I'll give you all of the details. You just fill it into a spreadsheet. So when you run into a block where you say, he hasn't told us what to do, it is intentional, right? So I want you to make a choice. I'm not saying all choices are equally okay. So clearly some choices are better than others, but I want to see what choices you make. Okay? So today I want to continue with our discussion of the Rio Disney theme park. So let's see where we are. Now, we projected the cash flows and the earnings of the cash flows in US dollars. We concluded that the project was a good project because its net present value was $3.3 billion, right? And the IRR was higher than the cost of capital. Last thing we did towards the end of the class was said, what if we'd done this right in the currency in which you'd be working with, which is Brazilian reais? And two things happened. One is when I switched from dollars to reais, my discount rate went up to almost 16%. Why? Because I added inflation. So again, let me be very clear. When you switch currencies, it's not that you're bringing in different risks or you're looking at a different project, you're bringing in differential inflation. But your cash flows also increased because the inflation was now helping the cash flows. The net effect was zero. If you do things right, your decision should be the same whether you analyze a project in US dollars, Brazilian reais, euros, whatever currency you pick. So today I want to start with a question where the answer is pretty obvious, but I want you to kind of go along with me. The numbers that I came up with, remember I was a number cruncher? Were they based on a lot of assumptions? In fact, let's look at all of the things that could go wrong. Could my revenues be overestimated? What went into my revenues? The number of people who come to the theme park, what price I charge, but this isn't real, I have no idea. Could it be that my costs could be higher or lower than, yeah, because I pulled the cost from Orlando and Anaheim, and who knows what the cost will be. What about tax rates, right? I used a tax rate based on what I knew at the time of the project, but tax rates can and do change. Interest rates, do they change over time? All the time. Let me cut to the chase. Every single number that I have in this forecast is an estimate, and every single number can be wrong. When you're fresh in this process, this is going to drive you crazy because you're saying, but I could be wrong, I could be wrong. And when you think about that uncertainty, there are some, let's look at the consequences. Here are some of the things you can do. One is, you can sit and wait for the uncertainty to go away. So Derek, how long would you have to wait for that to happen? Long time. So right now you might say, well, we'll wait for the Trump tariffs to pass. Guess what? There'll be something else 2 years from now, 4 years from now, 6 years from now. I'm sure there are a lot of companies that essentially are in waiting mode, waiting for the uncertainty to clear up. The problem is, you might have to wait forever. Second is, you might say, if I'm uncertain, I will not take an investment. Wade, help me out here. Where's Wade? He's not even in the room. I thought I saw him come in. Somebody help me out here. Second thing you could do is, you might say, I will not take the investment. If you do that, then what are you going to end up with your company invested in? If you will not invest in anything where you feel uncertain, where would you put your money? You're going to put your money in T-bills and wait and wait and wait. You're going to be a money market fund. So that's not going to work. You can ask someone else. Like who? Colin McKinsey. Ask them, should I take the project? Not that they have some crystal ball, but what's the benefit of doing this? If something goes wrong, you blame somebody else. It's not my fault. Let's face it, this is the biggest reason for consulting existing. Nobody wants to take responsibility for their actions. It's an easy way to pass the buck. I'd be glad if you're a consultant. It's a lucrative gig, but you're really not bringing in some certainty into the process. You can ignore the uncertainty. Are there people who can do this? And if you ever watch these poker tournaments and you look at the very top notches, I mean, these people are borderline sociopaths. I mean, you've got to be able to turn off all your human emotions. And there are people who can do that. Maybe you're one of those people. You can say, look, I don't care about uncertainty. But the truth is, for most of us, none of those four choices are going to be palatable. The question is, what do we do to deal with the fact that we're uncomfortable? It is natural to be uncomfortable. when you value company. This morning I was trying to value Tesla. You know how uncomfortable that made me feel? Think of all the uncertainties you face. In addition to all the electric car stuff, you now have to bring in the uncertainty of politics, the uncertainty of economics, all of these players. Yes? It's not just that the Zoom is not working, though it's not picking up my microphone. So unfortunately, they've sent somebody not picking up either my camera or my microphone. But tell them there'll be a second recording that's made. I don't know whether the camera works for that either. So for whatever reason, the camera is shut down and the technology is broken. But no, we got to go with what we have. Yeah. So the question is, what can you do to make yourself be able to make a decision? So let's go through some of the ways in which people have, because this is as old as time. As long as people have had to run businesses, they've had to deal with uncertainty. So let's look at one of the oldest techniques that people have used to kind of deal with the uncertainty. What's the big problem with this project? It's a huge project. You spend the money up front, $5 billion, right? There's a lot of uncertainty about the future. But one of the things you might say, look, I at least want to make my money back. It's a pretty reasonable place to start, right? Once I make the $5 billion back, then everything else is icing on the cake. That's technically not true. So what do? You count the cash flows till you get your money back. It's called payback. It's been around forever. And when you count up the cash flows and you look at the point in time you get your initial investment back, it's 10.3 years. You're saying, what do I do with that? There are companies that actually have constraints on payback. They will not take projects which have a payback greater than X years. If you're a technology company, you probably want to set a lower payback period, right? Because technology can change. It's a very simplistic way of dealing with uncertainty, but it's one, I mean, ultimately what you're trying to do is get yourself comfortable enough that you can make a decision, right? You're not paralyzed, you're not in denial. So look at the payback. The second is you can discount, because remember, making your money back doesn't make you whole again. Why? Because that $5 billion was tied up for 10 years. It could have been in T-bills, it could have been something else. So the second approach actually looks at the time value of money and looks at when you will get your money back on a discounted cash flow basis. Not that much different from payback, but you're essentially saying, if I wait 17 years, on a discounted basis, I get my money back. Those are big numbers, right? And you're saying, well, that's a lot of risk. With the case of Disney, with theme parks, you might say these parks last for 50, 60 years. It's okay. A technology company with those payback periods would never take this project. So that's the first and simplest way of dealing with uncertainty, is look to see when you make your money back. Any questions on payback? Okay. Let's move to the second way in which we deal with uncertainty. The second way we deal with uncertainty is we ask what-if questions. And it's become so easy to ask what-if questions. I mean, I'll give you a story to illustrate how difficult it used to be and why people did not ask very many what-if questions. I did my MBA between 1979 and 1981. For those of you who are familiar with the economics of this country, those were the Volcker years, one of the steepest recessions of all time. The economy had fallen off a cliff, inflation, they were trying to fight inflation. So that summer, 1980, I had to go find something to do because I needed money. I ended up working for a company called Watermark. I think calling it a company might be using the word company loosely. It was a business. You know what they did? They made radio shows, which they syndicated to stations around the country. The show that they made was called American Top 40. It's still around. Okay. In 1980, the DJ so the way the show worked is it's very low tech. What they would do is they would play down from the top 40 songs, starting with number 40, going down to number 1, with a disc jockey essentially giving you talk in the middle, right? Talking about, and those days you didn't know what was happening with the stars. He would give you these little tidbits. I ran into the star in the gym, and this is what we talked about. And the guy who actually DJ'd the show was a guy called Casey Kasem, at that time a legendary DJ. And it's a single show. It was syndicated to 520 stations around the country, each of whom paid $1,000 a week to get the show. It's a pretty lucrative business, right? 520 times 1,000, 520,000. I think Casey got paid 50,000 a week or some ridiculous amount. 40 actually did. And this was the only show. This business was that show. So they wanted to grow the business. You can't grow the show, right? 520 stations, you've hit pretty much every part of the country. So they decided to come up with an innovative concept. You know what their innovation was? To go back 20 years, take a week, because this was each week, right? Go back 20 years to a week in 1960, because it was 1980, go back to, take the top 40 songs from that week and do essentially, they called it soundtrack of the 60s. So it's American top 40 set back 20 years. Incredible innovation. They got this other legendary disc jockey called Murray the K. Now, at that time, legendary disc jockeys worked at radio stations around the country. They had people who'd actually tune into a station because they liked it. And Murray the K. So they said, they were hiring, and I was desperate, so I took the job. And they said, your job is to assess whether we should produce this show. Capital budgeting exercise, right? So I start off with a blank ledger sheet. So I go to the CFO and say, can you tell me how many stations you can sell the show to? He said, I don't know, that's why we've hired you. Can you give me a starting budget? So go talk to the marketing guy. I mean, this was a small business. There were little cubicles. So marketing guy was in a second cubicle. I walked over to the cubicle, and from the moment he saw me, he did not like me. So basically, he would act like I was not even there. And after about 2 weeks, I said, look, I need something to get started. Can you give me at least a rough sense of how many stations you can sell the show to? He said, I don't know, 200, 300, 400, somewhere around there. I knew this was all I was going to extract from the guy. So went back to my mini cubicle, and I got my worksheet going. Guess what my base case number was? 200, 300, 400. So I went right down the middle. Base case 300. I should have made it 303. It made it look like I knew more than I did, but I didn't know that then. So every line on this ledger sheet was like pulling teeth. But after about 6 weeks, I had the entire sheet filled up. Every cell calculated. And remember that it was calculated with a calculator and a pencil. I finished the whole thing. I computed net present value. Feeling really good about myself. All my MBA coming into work with my first corporate finance class. And I go to the CEO's office. And again, the CEO's office was the only one who he actually had a room. And I said, look, I'm done. And I'd like to present to you what I found. He said, let me call in the board of directors. He picks up the phone. He calls his two friends who are the board of directors. They come in. All three of them are sitting around. I go through the numbers, and then I hit the climactic moment. I say, based on my numbers, I don't think you should take the show. They look at each other and say, well, what if you tried 400 stations? My stomach dropped. Because remember, this is a ledger sheet. To change 300 to 400, what do I have to do? Go through every single cell. And I said, well, the NPV will probably turn positive. They said, well, then do it. I said, why? He said, we've already decided to take the show. We just want you to confirm it. I thought at that moment that this was just a small business being unsophisticated. But in the 40 plus years since, here's what I've discovered. This is more the rule than the exception. In most companies, people decide to do something, and then they look for justification. So much as we'd like to think that we do capital budgeting and we use the numbers to make a decision, in many businesses, the decision gets made first and the analysis follows. But asking what-if questions then was doing everything from start. It took hours to do. I actually did it with 400 stations. It took me a whole day. Today you have an Excel spreadsheet. You put in 300 stations. You compute all the numbers. As long as you don't hard code the numbers. And here's my advice to you. When you build Excel spreadsheets, I'm not a financial modeler, but here's one thing I've learned the hard way. Never hard code any numbers into a cell. Okay, so when you do the case, have an input page where all the numbers go. Have output pages where everything is read off the input page. That way, if you change your mind, you're not working through 50 cells. You're just changing one cell. It's become incredibly easy to ask what if questions. And I think it's become too easy. Every semester for the last 20 plus years, I've concocted these cases. Celsius this year, I don't even remember last year, it was, I think, Nike Apparel 2 years ago. Last year, it might be Tesla robots. So each year I make up this business. And you go through the process you're going through now. Work in groups, you come up with a case report. And every year I beg people, please, please keep it brief. Because you're not writing a novel and I've got to go through this. And most of the time, people listen. But I still remember about a decade ago, sent out this case. I don't know what the case was that semester. I think it was Home Depot Furniture, kind of a business. And I get these reports back, and there are 60 groups, and 59 have reports of 6, 7, 8 pages. They listen to me, and one has a report of 110 pages. There's always this one group that does this. So what the heck are you talking about for 110 pages? So here's what they've done. They've done 105 different scenarios on the case. They must have had a macro running through scenarios. Compute net present value under each scenario. But here's the bottom line. They get to the last page and they say, in 55 of these scenarios, we got a positive net present value. In 50, we got a negative net present value. We're too confused. You make the decision. And this, I think, is part of the problem with the what-ifs we run today. We think we're going to converge on some degree of assurance, but the more what-ifs you run, the more confused you get. So if you're going to run what-if analyses, which I think you will be tempted to do on this case, I have two pieces of advice. One, less is more. Don't take every variable and change it. Pick the 2 or 3 variables that you think drive the NPV the most. So I want you to start thinking about Celsius heats. Of all the assumptions I've listed, which one is the big one? Which one's going to drive your, and focus your what-ifs on that. And second, when you present your what-if analyses, for God's sakes, don't create 50 more exhibits with numbers. Because the human mind is incapable of dealing with those numbers. It's mind-boggling. Think of a creative way of presenting those numbers in a picture. You think that's easy. There's an insert chart in Excel. It's the laziest device ever, right? I've seen charts introduced for 2 numbers, to compare 2 numbers. I don't need a chart if you have 2 numbers. You just give me the first number and the second number, but you'll have 2 big bars next to each other. Look, the second number is bigger than the first one. Thank you for letting me know. 250 is greater than 150. If you want to see, and I think part of the problem is in Excel, everything can be converted into a chart. If you really want to see good charting, there's a guy called Edward Tufte. He might be retired now. I think he used to teach at Princeton. And he used to teach about visually displaying information. In fact, his most famous book is called The Visual Display of Information. You can get it on Amazon for less than $10. Well worth the money. And what he looks at are creative ways in which people have presented data with pictures. And my favorite chart of all time is somewhere in that book. It's a chart that shows you what happened when Napoleon decided to invade Russia. I don't know what it is about Russia and European monarchs, but every 10 or 20 years they seem to get in their head, I want to invade Russia. So Napoleon wakes up one day, supreme ruler, and he's got this reputation, great French army, and he says, I'm going to invade Russia. So the entire army takes off. See the width of this line? That's the Napoleon's army leaving Paris. So the width of that line is the big army. So they're marching through Europe. You see, what are these little tangents? They get distracted, invade Poland and other countries in the middle. They march and march. It takes them a long time to get to the Russian border. Remember, these are not cars they're going in. They're going on horses. Napoleon on a horse, others are marching. They get to the Russian border, and Moscow is still a long way away. So they keep marching and marching. They get to the outer limits of Moscow. The gate is still there in Moscow. Russians are very proud of it. They get to that entry to Moscow, and they discover that Moscow in December is not a nice place to be. He says, this is really cold. We want to go back. So there's the French army on its way back. And as it's going back, take a look at this. This is the temperature that they're walking through. And as the temperature is freezing, the army is getting smaller. So by the time you get back to Paris, it's three guys carrying Napoleon in. The army is gone. This is a great chart. There are entire books on Napoleon invading Russia. This chart brings home the whole story. So if you want to show me what will happen to Celsius Eats if the market share and total market are different, hey, you have a much lesser task. You can do it creatively. So it's something I see more and more of people thinking about. How do you present information visually? You know, there are a couple of programs out there where actually you try to present things in interesting graphs. The New York Times experiments, sometimes you can see it in some of the experiments. They have bubble charts where they just don't put scatter plots. Think of creative ways of presenting your data. So you can ask payback questions, you can ask what if questions. I'll give you my favorite device for dealing with uncertainty. And it's a device I could not have used 40 years ago, 30 years ago, even 20 years ago. Maybe not even 10 years ago. Heard of a Monte Carlo simulation? First, you're familiar with Monte Carlo, right? In Europe, it's gambling, casinos. Monte Carlo simulations essentially take what we do and bring in statistics into the process. When you say you're uncertain about a number, Leon, when you say you're uncertain about a number, help me out here. What exactly does that mean? You say, I am uncertain about a number. In other words, you can give me a number, but you say, but I could be wrong. If you ask me how many games will the Yankees win this season, I could hit you with a number. 155. No, that's not going to happen. That's hope. But given what we're, maybe 90 games. Am I certain about it? Absolutely not. But uncertainty just means there's a range around your estimate, right? There's a distribution. That's basically what uncertainty means. And for the longest time in finance and in investing, we worked with point estimates. What is point estimates? For every number, I want your best estimate. That's not a bad practice, but I'm asking you for an expected value. What if, in addition, I allowed you to give me a distribution on that value? In other words, you say you're uncertain. Tell me how uncertain you are. So what I did here was I took my Rio Disney and I said, I gave you numbers, but you know what? I'm not that certain about them. Remember that revenue number I gave? Well, I could be off by 20% in either direction, plus or minus 20%. My base number I believe in, but there's a distribution. This is called a uniform distribution. When to use a uniform distribution? When your beliefs are completely diffuse. It could be anywhere from 80 to 120, and there's no reason for you to believe it's centered around a number. Remember that 60% margin that I had, 60% direct cost that I had for the theme parks? Where did I get that? By looking at Orlando and Anaheim, but this is in Rio. I could be completely off. I think the 60% is my best case estimate, but this is called a triangular distribution. It's symmetric, basically, that the true cost can be anywhere from 45% to 75%. You see, my base case is still the same, but I'm providing a distribution. And for the country risk premium, Brazil could get riskier or safer. If you remember, I had a 3% country risk premium. I said that too can change. You put those distributions in. Here's how a simulation works. The computer goes and plucks one number out of the revenue distribution. That number could be higher than my base case or low. Let's say it's 104%. My expected revenues are now higher. It goes and plucks a number out of the operating expense. So let's say it's 58%, lower than my 60%. It goes and plucks a number out of the country risk premium. Let's say it's 2.8%. So on all three, I got numbers better than my base. I valued the project. I'm going to come up with an NPV of 4 billion instead of 3.3 billion. I do it again and again and again. The way this was taught to me in my statistics class is my statistics professor actually brought in 3 big glass bowls with papers, where he'd written numbers and he plucked one out. And if you do that, you can't do this hundreds of times. It's time consuming. But a computer can essentially do it in seconds. 40 years ago to do this, though, you'd have needed access to a mainframe computer. You'd have had to pay millions of dollars to run it. Today, if you have Excel, at Stern we have a program called Crystal Ball. If If you've seen it in passing, you say, what the heck is it? Here's what Crystal Ball does. It adds on to Excel. And when you enter a cell, for instance, I ask you, what are the direct expenses? With Crystal Ball installed, you can say, my direct expense in that cell, you can enter a number and enter a distribution for that number. 60% uniformly distributed. Crystal Ball's default is it runs 10,000 simulations in a minute. You could set to 100,000, it'll take it a minute and a half. You could set to a million, just play with it 2 minutes. And as it runs, you can see the distribution of the net present values show up. You think, what do I gain by doing this? First, the median net present value is 3.3 billion. Does that look familiar? That was my NPV in the base case, but that shouldn't surprise you. Why? Because every distribution was centered around my base case. But here's the output from a simulation that you can use in your actual decision. Remember, you run best case, worst case sometimes? It's already in here, right? My best case is 8.5, 9 billion. My worst case is minus 1.1 billion. It's in there. But you can also look at the 10th percentile, the 20th percentile, the 30th percentile, and you can say, look, I'm getting a sense of how much variation there is in this project. You're getting a sense of how uncertainty will play out here. I mean, I call this facing up to uncertainty. You're not hiding from it. You're not in denial. You're saying, I want to look. That's what I plan to do in my Tesla valuation. I'm going to make my best case estimates, and after I'm done, I'm going to run a simulation. And guess what the simulation is going to show? It's a huge range, and that's always been the case with Tesla, but now that you have the added politics of the moment, you're going to get an even wider range. Does that bother me? No, it is reality. And as an investor, you got to factor that into your decision making. Any questions on Monte Carlo simulations? So if you get a chance, try Crystal Ball. The one thing I would caution you is if your statistics is a little fuzzy, Crystal Ball will make it clear. And here's what I mean. When you pick so the way Crystal Ball works is you decide to make a cell, an input cell into a distribution. It'll ask you what distribution do you want to use. It'll give you 53 different distributions you can pick from. And if your statistics is fuzzy, you're going to look at those 53 and say, what's an exponential distribution? What's a log normal distribution? What's a Bernoulli distribution? And guess what the only distribution that's going to look familiar to you is if a statistic class has become fuzzy. You're going to find that everything is normally distributed because that's the only distribution you actually recognize. It's garbage in, garbage out then. If you're going to use this, at least spend, and I have an 8-page kind of documentation on how to pick between distributions, kind of a speedy run through different kinds of distributions. Take a look at it because it'll give you the tools at least to bring simulations into play. Incredibly powerful tool, no matter what aspect of business you decide to go work in, marketing, strategy, it allows you to face up to uncertainty and bring it into your numbers. So now let's assume I'm back to you as a decision maker. So I've done the simulation. I present to you with the output, which is your median value is about 3.3 billion, but there's a lot of uncertainty. In fact, there is a 12% chance. If I count the number of times I get negative NPVs, there's a 12% chance this project could be a bad project. The ball's back in your court, right? You have a positive NPV, but there's a 12% chance the NPV will be negative. So here are the choices you have. You can still accept the investment, print the results out, and put it in a folder. Why? Because then if somebody says, did you do your due diligence, you pull it out, and you say, look, which is pure covering your rear end. And a lot of people ask what if questions precisely for that reason. That becomes the definition of due diligence. The second is that you will reject the investment because you want zero chance of negative net present value. This is a very conservative strategy. There are businesses that might adopt it. But if you do it, you're actually double counting risk, right? In what way? How do you compute the NPV? You took the expected cash flows, you discounted them back at a risk-adjusted discount rate. And because you got a risk-adjusted discount rate, you already factored in risk, and now you're counting in risk a second time. So you're saying, why bother then? Because it's not just taking the project, right? You got to run the project. What if you ran the project differently? You got a better distribution. One way reason you're getting negative net present value is the cost becomes 75% of revenues. And what if there's a way you can prevent that from happening by maybe entering into preemptive wage contracts where you're willing to set 63% as a cost rather than 60%, but in return, the people who work for you say, look, we're not going to go on strike, we're not going to walk out. It's becomes a tool for you to decide how to run the project to minimize the downside risk and the damage to you. So any questions on uncertainty? Because that's going to come up when you do the project. You come up with an NPV and ask you to make a decision. You're going to have this discussion as a group of there is this NPV. If it's positive, of course, you say, I'm going to think, but there'll be somebody in the group who says, what if this happens? It's good to ask those questions, but you still have to remember your ultimate mission here is to make a decision. Right? So let's talk about Disney Plus. That's Disney's big new business, right? Disney Plus was the history is a little strange because this happened at the peak of COVID. Bob Iger leaves, Bob Chapek comes in, and he decides to reorganize Disney from the 5 divisions you saw into 3 businesses. The TV business, so basically it's a, and he threw all his chips on the table on the streaming business. That was going to be what made Disney a growth company again. Invested billions of dollars. The Mandalorian, as I said, became the show that made Disney Plus into a subscriber heaven because people signed up because they wanted to see that. It was almost as good as Game of Thrones for HBO. If you remember, there were people who would actually sign up for HBO. HBO is a very different strategy. They didn't go with the Netflix hundreds of millions. They went for fewer shows, smaller audience, presumably more loyalty. So Disney Plus was built up, but basically it's a division that's sucking up huge amounts of money. There's no way Disney Plus can compete with Netflix on content, number of shows, because Netflix just makes shows, throws them against the wall, hope something sticks, right? 20 shows a day. Disney Plus can't do that. No entertainment business in history has been able to do that. I mean, that's why I think Netflix has broken the entertainment business. Because by making that many shows with Amazon Prime on the side, they've essentially broken the business, made it almost impossible for traditional content companies to exist in that business. But that's a story for a different day. Disney believes it's going to be one of the survivors from this broken business. So Disney Plus is the place they're going. So if you look at a new Disney Plus show, let's say you work at Disney, you're the person in charge of Disney Plus, you know you got to come up with new shows to keep the subscribers on. It could be an Avengers show, it could be a Star Wars show. Basically, those are the 2 big contributors to the new shows. And I come to you with a new show, and I say, we want to make the show. Remember, this is not a cheap exercise. Even The Mandalorian cost 15, 20 million. Look at Daredevil, 35 million. 8 shows, you're looking at essentially a $300, $350 million spend just on the content, not to mention the advertising, the other stuff. It's like a $500 million investment. So how do we analyze investment? We look at what you invest, right? $500 million. But then we have to estimate the expected cash flows. And already you can see the struggle you're going to have when it's a Disney Plus show. If you were making a show for traditional broadcasting, where did the revenues come from? You made a show for ABC. Traditionally, you made the show, it cost you money, but your money came from advertising. So if you had high ratings, you sold more advertising. Disney Plus doesn't sell advertising. There's a version I know that sells it, but the bulk of it is just subscribers. And the only way you justify the show is if we don't make it, we will either lose subscribers, or the positive spin is we'll get more subscribers. That's tough to measure, right? Because when somebody adds Disney Plus, nobody asks them, did you add Disney Plus because you wanted to see Daredevil? You got to make that leap of faith of that's why they did it. It's incredibly mushy in terms of how you determine the benefits, which also means that you can explain why Netflix is doing what it's doing, which is they have no idea whether a show creates additional subscribers or not. It's a terrible way to run a business. I mean, I describe Netflix as a hamster on a wheel, where you can't really get off the wheel because you're training people to expect 10, 20 new shows. But basically, that's something I want you to think about is, When you have a business like this one, increasingly in platform businesses, you're spending money, but there's no direct relationship to your revenues. How do you measure incremental revenues? Eventually, I think streaming platforms are going to have to figure this out, because we can't keep doing what we're doing, which is make the shows, hope it works, assume that the numbers are what they are because of the shows, when in fact there's no direct way of connecting them. Technology might help them because they might see what you're watching, why you drop. Maybe there'll be more information you get when you sign up or you drop, but it's coming. It has to come. Otherwise, it's impossible to have discipline in investing. So we looked at two Disney projects, very different, a theme park and a show. You can already see within Disney, they will have very different characteristics. And if you think about what discount rate would I apply for Disney Plus, it's going to be very different than the discount rate you would apply for a Disney theme park. So I'm going to move to a third project. This is a project from an old economy company, Vale, an iron ore mining company. And I'm going to do this entire project analysis in equity terms. Let me explain what I mean by that. If you go back and look at the Disney theme park analysis, I computed the operating income on the theme park. I ignored interest expenses. I looked at the cash flows you'd make before debt. So if there are debt payments, I completely ignored them, right? I looked at cash flows before debt payments. And when I discounted those cash flows, I used the cost of capital because money is coming from both debt and equity. And I computed an NPV. I took a tangent where I computed an accounting return, but the return I computed was return on invested capital, after-tax operating income as a percentage of invested capital. And I compared it to the cost of capital. So in an equity approach, I'm going to take a slightly different tack. I'm going to focus just on the equity investors. When I look at earnings now, I'm going to focus on net income, not operating income, income after interest expenses. When I look at what returns they make, I'm going to look at net income as a percent of book value of equity, not invested capital. And I'm going to compare to the cost of equity. When I do my cash flows, those cash flows are going to be after debt payments. So here's the project. There's lots of information on this page. Let me summarize what it looks like. First, this mine will require an initial investment of 1.25 billion and the production capacity will be 8 million tons. How do you know? Because some geologists came in and said, there's iron ore there, you're trusting them, they're 8 million tons, 1.25 billion. That investment is going to be depreciated down over 10 years using some accelerated depreciation method. So more depreciation up front, less later, down to a salvage value of 250 million. Already I'm leading you to a different end game here than in the Disney theme park, right? The Disney theme park, I estimate the cash flows for the next 10 years, and what happens after year 10? It continues as a theme park. Why am I not making that assumption here? Why can't this iron ore mine keep continuing as an iron ore mine? Because there's no more iron ore in the ground, right? So this is a finite project. You can't just make up terminal values when the game is over. So in this case, at the end of 10 years, I have salvage value. I sell off equipment, what's left, for 250 million. The mine will start production midway through the year, and it's going to take a while to build in. So, you won't produce 8 million tons next year. And this is a reality. A lot of natural resource, it takes a while to build up to full capacity. And as you do that, you need to get a price per ton. The price per ton of iron ore at the time I did this analysis was $100 a ton. I could make predictions about what that price will be optimistic, but I don't want to do that because I want to decide on this mine based on what I know about the iron ore price today. So what I'm going to do is assume that price stays constant in real terms. Inflation terms, of course, it's go up at the inflation rate, $100 per ton. So that's going to be the price all the way through. The variable cost of production is expected to be $45 a ton. So remember, the price is 100, the cost is 45. But there's also a fixed cost of 125 million every year from operating the mine. Everything is locked into the inflation rate of 2%. Why? Because I want to keep things simple. I mean, clearly I could have brought in complexities here, but I'm keeping things simple. There will be a working capital requirement of 20%, and the investments have to be made at the beginning of each year. Why does that matter? Because in terms of timing, that means to get the working capital going for year 2, I need to bring it in at the end of year 1. Remember, the beginning of year 2 and the end of year 1 are essentially the same point in time. It's December 31st versus January 1st, so that's why that matters. And finally, the corporate tax rate is 34%. So I've pretty much given you the details. But since I'm focused on equity, I also have to tell you where I'm getting the 1.25 billion. The Disney theme park, I never told you where the 5 billion came from, whether it came from debt or equity. Here I have to be explicit. They are going to borrow a $500 million out of the 1.25 billion. And I also have to tell you what the terms of that debt are. It's going to be a term loan. What's a term loan? You basically pay it off in equal installments over the next 10 years. What's the other type of, other common type of loan? You can have a term loan, which is what your home mortgage is. But what's the other type of loan? What's a corporate bond? Is a corporate bond a term loan? No, you pay only interest each year, and then you pay the face value at the end. It's a balloon payment loan. So basically, I have to give you the details. Why? Because you need to figure out what your debt payments will be each year. In this case, your debt payment is exactly the same every year. Why? Because it is a term loan. That's how term loans work. But the portion of that payment that's interest and the portion that's principal will change over time. Now, if any of you get a home mortgage, you will see this actually in your mortgage statement. The year that you take the mortgage, if it's a 30-year mortgage, almost the entire payment will be interest. If you stay all the way through year 30, which very few people do, by the time you get to year 30, your total payment will be the same. It will be almost all entirely principal. So you're going to see that pattern here. You basically have the interest expense decrease over time, the principal portion increase, but the total pay. Why do I care though? If the total payment stays the same, why do I care how much is interest and how much is principal? They're both cash outflows. So what difference does it make with the interest or principal? Tanmay? No, but why do I care what that interest is? Right? Total pay, it's a cash flow, so what does it matter? Tax, because I'm allowed to deduct interest expenses for tax purposes, but I am not allowed to deduct principal payments. Already you can see why doing cash flows equity is messier, right? Because I've got to break up into interest and principal. But that's the reason I'm doing it. So I've given you the details of the project, I've given you the details of how much I'm going to borrow. The question is, what discount rate should I use, assuming I can get to the cash flows, right? So here are Vale's numbers for the different businesses, cost of equity, cost of capital. I did my cash flows entirely in US dollars. The inflation rate you saw was the US dollar inflation rate. Why? Because it's a commodity company. It's much easier to do in dollars anyway. So I want to use a dollar discount rate. But given that I'm estimating cash flows after debt payments, I want to use a cost of equity. The cost of equity here in dollar terms is 11.13%. Now I want to make sure it's a cost of equity for, I'm following exactly the same principle that I did for Disney, which is where I use the theme park cost of capital. Here I'm using the iron ore cost of equity because it's an iron ore project and I'm looking at cash flows after debt payments. So 11.13% is going to be my discount rate. So let's look at the numbers. I know there are a lot of numbers in the table, but let me at least give you the big picture and what I'm trying to do. For the next 10 years, what do? I extract iron ore from the ground, and I've told you how much because you're building up to that 8 million tons. I sell it at the prevailing market price, which I've assumed to be in constant dollar terms $100, but because there's inflation, the price goes up at the inflation rate. So that's the number going up, 2% a year. You multiply the tons by the price, you get the total revenues. I subtract the variable cost. The variable cost is always $45 a ton adjusted for inflation, so it's always going to keep up with the revenues. But the fixed cost, 125, just grows with the inflation rate. I subtract out the depreciation from the initial investment. I come up with operating income. With Disney, I stop there, right? Here I keep going because I want to bring in the interest expense to come to taxable income. That's why interest expenses matter. I compute the taxes at 34%. I've got my net income. My end game here is net income because I'm focused on the equity investors in the company. To divide that net income, I start with invested capital. So it looks again like I'm doing exactly what I did with the Rio theme park. I take capex, subtract depreciation. But here I also subtract out the debt outstanding from that invested capital. What does that give me? It gives me the book value of equity. When you've decided to go the equity route, you got to wear blinders. Everything is about equity investors. You're looking at net income, earnings to equity investors, book value of equity, which is what equity is invested. You divide net income by the book value of equity, you get what's called the return on equity. Return invested capital, you look at operating income, invested capital, return equity, you look at net income and book equity. My average return on equity for this theme park, for this iron ore mine is 31%. But here, if you look at the ROE column, notice how steeply it climbs. Why is that happening? Why is the when I did this for Disney, the return on invested capital didn't explode out. It went up, but it didn't go to 50, 60%. What's happening here that's making the return on equity so high by the time I get to year 7, year 8, year 9, and year 10? Constantine, what do you think it's causing? Sorry? I didn't hear you. What did you say? But carry that through. It's not just that. What's happening to my asset? Because it's a finite life. And why is my equity going down? It's a finite life asset, right? So I'm depreciating the asset. So what happens to the book value over time? It decreases. In the case of the Rio theme park, remember I put my money back in because I wanted to. That's what's so. If you have a finite life project, I will safely predict that older projects will look amazing on a return equity basis, not because they're amazing projects, but because you've written down your money so much that there's so little. It's the denominator that's essentially imploding. The net income is not soaring, but the book value of equity is getting so tiny. So it's a feature, not a bug of accounting return equity, that older projects will always look better on a return equity basis than younger projects. And to make the comparison, that is higher than my cost of equity for iron ores of 11.1. So on an accounting basis, this project looks good. But as with the Rio Disney theme park, we know accounting returns are not that good. So I'm going to try to compute the cash flows. Before I do that, though, I'm going to take the tangent, just as I did for accounting return capital. Remember there we computed return on invested capital for the entire company. I think for Disney we came up with 12.81%, higher than their cost to capital, and we said it's a very rough measure of, is this company taking good investments? I could do the same thing with return equity. I could compute the return equity, but here I would compare to the cost of equity for the company. And if you look at Disney, their return on equity in 2013 was 14.62%, net income divided by book equity, much higher than the cost of equity. I'm getting confirmation of what I got with the return capital. I've asked you to do this for your company when you on your project, and when you do it, for many of your companies, you'll get confirmation. For some of your companies, you might actually get divergent signals. In other words, one measure will say this company is taking good projects, the other might say it takes bad projects, and I want you to think about why that might happen, because you will run into this for some of your companies. And it's an accounting return, and the answer might lie in how we computed the numbers and what goes into those numbers. So as with the Rio Disney theme park, here I'm going to go from net income to incremental cash flow. Process is very similar. Add back depreciation, subtract capex, subtract change in working capital, but there's one additional line item you have now that you didn't have with free cash flow of the firm. Remember, now you look at equity cash flows. You got to pay the loan back. There's principal payments come into play here. You subtract those out, and in year 10, you wrap up all your loose ends. A project is done, put in the salvage value. If you have working capital, you're going to get it back. In fact, if you look at the working capital number, these numbers for the first 9 years, working capital drains your cash flows. You're saying, why is there a working capital right now? Year 0 is not a year, it's actually today. That's my working capital for year 1. Remember, I have to invest at the start of the year. But at the end of year 10, I get all of my working capital back. If that sounds like a mechanical thing, this is like you're going out of business sale, right? So if you ignore working capital in year 10, you're essentially taking your inventory, throwing it in the streets and saying, I'm done, therefore I don't care. You call your people who owe you money, say, don't pay me. I'm done with the project. It doesn't work that way. You're trying to get your working capital back when you salvage the project. So when you get to the end of a finite life project, tie up loose ends. Get the salvage value on what you can sell. Get as much of your working capital back as you can. And generally, it's a good idea to get your entire working capital back simply for a mechanical reason. If you set to a number other than your book value, you'll have a tax consequence, right? So basically, I'm ignoring that and I have my free cash flows the cash flow to equity on this project. It's after debt payments every year. I discount those cash flows back at my cost of equity, 11.13%. What I get as a net present value, 304 million. Confirming what my accounting returns told me. This is a good project based on equity cash flows and the cost of equity. The net present value is 304 million. Any questions about equity? This is, I think, one of the things that even people who are seasoned in cash flows, sometimes they can't do the divide between firm cash flows and equity cash flows. As long as you stay within your lane, you say, I'm focused on equity, all I care about is equity, everything will play out. No, but the mistakes often happen because you go back and forth across that line. Yes?
On the ROE analysis,
Yeah.
you're using like a weighted average to calculate the ROE return?
Yeah, when you do the accounting returns, steer away from time values, steer away from weighting, because the only way you can do a weighted average, and I'll give you a very simple way in which you can compute it, add up the net income across the next 10 years, add up the book value of equity. It's an aggregated number. It's probably a better number than taking that simple average. So if that's what you mean by weighted average, it is in fact a better way of computing return equity for a project with a 10 or 15-year life.
And then add it to the number of years.
You don't even have to divide it, right? If you take the total net income over the next 10 years and the total book value of equity, it'll already be a number. So you don't have to divide by 10. It's an aggregated return on equity for the entire project over their lifetime. And it's usually more stable, because otherwise with projects like this, those last year numbers become so astronomically high that when you compute the average, they just pull the average up, right? You get a 300% ROE in year 10. You could have a terrible project, but it basically pulls up the return equity for the project. Now, this basically is the net present value profile, where essentially I took those cash flows, changed the discount rate. My internal rate of return for this project is in excess of 17%. Is that good enough? Yeah, my cost of equity is 11%. This is a good project on an accounting return basis, an NPV basis, and an IRR basis. Here again, I'm going to ask a what if question. I did everything in US dollars, right? How did that play out? 2% inflation rate in my price, 2% inflation rate in my cost. Could I have done everything in real terms? Or tell me, what would be different if I did everything in real terms? First, my 11.13% cost of equity was a US dollar cost of equity, right? Roughly speaking, what's my real cost of equity going to be? The inflation rate in US dollars is 2%. 11.13% is a US dollar cost of equity. I'm going to take the 2% off. My real cost of equity is going to be about 9.13%. You think that's bad? No, that's good. The discount rate is lower. But remember, when I do my cash flows, I now have to take inflation out. So the price I will use for iron ore every year for the next 10 years is going to be $100 every year. There's going to be no inflation effect. You can trust me on this or actually work through the numbers. Your net present value will be exactly the same if you take the inflation rate out of both your numerator and your denominator. Kind of a confirmation of what we found with currency. It's inflation that is the wild card. And as long as you deal with it consistently, it doesn't matter whether you do things in nominal terms or real terms. Now, when you look at this project, the things you're worried about are not the kinds of things you worry about with a Rio Disney theme park. There you're worried about what I think of as company-specific, project-specific things, which is how much will it cost me to sell snacks on the theme park? Will the tourists come into? When you look at an iron ore project, you know what the big number that drives the value is the price of per ton of iron ore. I used $100. But you know what the normalized, the average price was going back a century, on inflation adjusted basis? It's about $50 to $60. What pushed it up to $100? China. China between 2003 and 2016 screwed up every commodity price cycle because it pushed up, because the infrastructure they were building required so much, iron ore and steel. So you can already see the worry you have, right? If you're at Vale, you look at this project with $100 iron ore price, you're okay. But if that price becomes 90 or 80 or 70, you very quickly see the net present value turn negative. In fact, if the iron ore price is less than $90, your net present value is negative. The IRR becomes less than the cost of equity. So file that away. Second, it is also affected by exchange rates. In this case, the exchange rate between the US dollar and the Canadian dollar, and here's why. The iron ore mine is in Canada. All your costs are in Canadian dollars. You sell your iron ore into a dollar based market. As the dollar, as the Canadian dollar strengthens versus the US dollar, okay, you have a strong, your costs will go up. Your revenues are not, so your margins are going to get worse. So if the Canadian dollar weakens, you're in good shape. The Canadian dollar strength. So there are two big macro risks you have. One is what will happen to iron ore prices. The second is what will happen to exchange rates. Right? But those are macro risks. Can you protect yourself against those risks? First, let's take the exchange rate risk. If you're worried about the Canadian dollar getting stronger or weaker, what can you do to kind of protect yourself? This is the most protectable macro risk out there, right? You can use forwards, you can use options, you can use derivatives, you can hedge against exchange rate risk. What about iron ore prices? Can you hedge against that as well? Can you lock in? Yeah, there's a forward market. Commodity companies can lock in their prices. It sounds like a great deal, right? So I have a practical question. Given that you can hedge against this risk, let's take each of the risks. Okay? You could go out and hedge against iron ore risk. What does that mean? You lock in the price today based on a forward market. That's good, right? It makes your revenues more predictable. You think they should do it though? I'm asking a more general question. Should oil companies hedge against oil price risk? Should gold mining companies hedge against gold price risk? Play it out in your mind as an investor in the company and tell me whether this is good or bad, whether you want. When you invest in ExxonMobil, first you had to overcome all those concerns you had about climate change. But let's say you got there and you invest in ExxonMobil. Why are you investing in ExxonMobil? Because you like their management? Now, what's the reason you invest? Because you think oil prices will go up. You're making a bet on oil prices. Let's say ExxonMobil now goes and hedges its oil price risk. Oil prices go up by 30%. You're happy at home saying, I made the right bet. Then you check your stock price. Hey, what's happened here? Nothing seems to have happened. Investors invest in commodity companies because they're making a bet on commodity prices. The worst thing a commodity company can do is go out and hedge against that risk because it undercuts your reason for investing in the first place. Barrick, which is one of the leading gold mining companies in the world, did this in the 1980s, and its entire management team lost their jobs because gold prices went up and Barrick's stock price stayed flat. Investors said, what the heck happened there? They said, we hedged against risk. No, we don't want you to. Not all risk should be hedged. And I'm going to give you a flow chart. And if it's an output risk, you have to be particularly careful because investors are betting on your company based on the output risk. Go ahead.
What about like right now with lumber?
Hey.
Stuff with a more than likely.
See, there are two things where lumber plays out. One is the companies that make lumber. There's lumber prices. There are companies for whom lumber is a cost. The answer is going to be different depending on who you ask about. So if you're a furniture company and lumber is a cost, and this is a hugely volatile item, I think there's an argument to be made for hedging that risk because otherwise, how do you decide how much furniture to make, right? But if you're the lumber producing company, remember, the price is an expected price. It can go up or down. It's not like you can say there's an 80% chance of it going up and 20% going down. It is, in fact, already found its steady state. I would give the same advice for a lumber producing company as well, unless it has a lot of debt. Do you see why that might play out? If you have a lot of debt, one of your concerns is the price drops, there's no recovering back because there's no cycle because you're going to go out of business. So maybe if you have a lot of debt and you worry about that downside risk, you might step in and say, so if you're a shale oil company with a lot of debt, there's an argument that you might want to hedge at least some oil price risk so you don't go bankrupt if oil prices go to $50 a barrel. So that's the exception to the rule. In general, you've got to be very cautious as a commodity company hedging your output risk. What about exchange rate risk? It's the most hedged risk in the world. You know how much money companies spend hedging exchange rate risk? It seems like a freebie almost. There's so many ways to do it. By hedging exchange rate risk, what do you gain as a company? How does it play out in your numbers? Your costs are more predictable, right? Your earnings are going to be more stable. And if you're a company telling the story, the banker selling you the exchange rate protection, how does the story play out? Your more stable earnings, investors will pay a higher multiple of your earnings, you'll be worth more. Complete lie. You know why? Because there's zero evidence to indicate that having more stable earnings by hedging exchange rate risk translates to a higher PE ratio. Saying, why aren't investors rewarding me? If your investor is BlackRock or Fidelity, which is often the case, and they own 100 companies, all of which are exposed to exchange rate risk. Remember, exchange rate risk cuts in both directions, right? 50 of your companies are helped by a stronger dollar, 50 are hurt. It, no, in their portfolio, what happens to exchange rate risk? It goes away without spending any money. What are you doing? If each of these 100 companies now goes and hedges, the only people who benefit are the people selling you these products. If you are a company with diversified investors, I would actually argue let the other risk go. In fact, I think far too much risk is hedged against. We'll talk about why people might do it, why managers might choose to do it, even though there is no payoff for shareholders. But think like a manager and think of why hedging risk makes your life easier, even though shareholders don't get a benefit. But if you ask me what is the payoff to shareholders, it's tough to find any. Now, if this mine were in Brazil rather than in Canada, maybe there's a case for hedging against exchange rate risk, because if it's so volatile that it can tip you into default if the wrong thing happens, maybe then. So already you can see, if a manager asks you, should I hedge? The answer is going to be nuanced. I'm going to give you the framework I use whenever somebody, and because I get this question all the time, in fact, it's one of those things where I look at the research and say, how come people are not answering questions like this in academic research? It's almost like it's too pragmatic a question. Should I hedge? Let's play it up. Now, if you ask me, should I hedge? The first question I'm going to ask you is there a cost to hedging? If there's no cost, what should you do? Hedge away. Retail firms hedge against location risk. You know what I mean by location risk? If you're a retailer with a single store, you worry about location. If the highway moves in the other direction, you might lose all your customers. But if you're a retailer opening stores across the country, location risk gets averaged out. A Walmart doesn't think about any individual location risk because it averages out. That's risk you're getting rid of. So in the course of operations, you manage to hedge away risk, all the more power to you. But if there's a cost to hedging, then I have some questions. First is, what is the benefit to hedging? And don't show me that banking earnings per share being more stable. That doesn't help me. You got to show me something more tangible. It can either be that, you get some discount rate effects, that people reward you with a lower discount, maybe a lower cost of debt, maybe bankers will lend you money at a lower rate if you hedge. I want to see how much this benefit is so I can weigh it off. Maybe there's a cash flow benefit. Maybe you get a bigger tax benefit by hedging and showing more stable income over time. Or maybe as a manager, you make better decisions if I let you hedge. You know what I mean by that? As a manager, you might be one of those types, who gets really stressed out when there's a lot of risk. So you go into so you say, if you let me hedge, I'll make better choices. And if you carry that through, but show me the benefits. I'm not just going to let you hedge because you show my earnings are more stable. Or your argument can even be made in terms of pricing arguments. If you can show me that companies that hedge trade at a higher multiple of earnings, I'm willing to listen. But I need to see the benefits. But if there are benefits that exceed the cost, then I have a follow-up question. Can your marginal investors hedge this risk cheaper than you can? And that's where the BlackRocks and the Vanguards come in, right? If you're a global company held by big global investors, I don't think you have any business hedging any risk. If you're a small company which is closely held, the owner owns 30% of the company, his or her wealth is tied up in the company, I think there's an argument for hedging because your wealth could go down the drain. You don't have the benefit of diversification. that diversification argument we used earlier is going to kick in here. And whether you should hedge or not will depend on what kind of business you are and how much of your wealth is tied up in it. So you own a private business, you probably should hedge. Right? Your entire wealth is tied up in the business, you're not diversified, you're a publicly traded company as a manager. I know it makes you sleep better at night, but I would think medication for that is cheaper than the hedging cost. So maybe I will pay for that medication so you can sleep better at night. But don't use your interest as a reason for me hedging away risks that trouble you. Right? Any questions on hedging in general? Right? So let's talk about acquisitions. I've never understood why when we teach finance, we teach capital budgeting, and then we talk about 15 sessions later, we get to M&A. What does that do? First, it carves out an exception, right? An M&A is not a capital budgeting project. In what universe is it not a capital budgeting project? An acquisition is a gigantic project. Play it out. What's the initial investment when you do an acquisition? It's what you pay for the target company, right? That becomes your initial investment. What are your expected cash flows? They come from the cash flows of the target company with two qualifiers. One is that if you can change the way the target companies run, remember you now own it, maybe your cash flows can be higher. That's called the value of control. The second is that maybe by combining the two companies, you get cash flows you would not have got otherwise, which is synergy. Still cash flows. So acquisitions basically look very much like traditional capital budgeting with that added qualifier of control and synergy. So here's what I'm going to do. I'm going to start with, and the principles on what discount rate to apply are exactly the same. The discount rate should reflect the risk of your project, in this case the target company, and the mix of debt and equity that that company can carry on its own, not what you come up with in the acquisition. So here's the project that I'm going to look at. Tata Motors is one of the companies we've been looking through all the class. It's a traditional automobile company. It's looking at Harman Audio. It's high-end audio systems. Why? Partly because Tata Motors wants to bring in another car, but partly because it wants to use the audio systems in its cars, hoping to sell more cars, make them more attractive. There's synergy, the talk of synergy. We're going to try to put a number on it. But in the initial analysis today, I want to value Tata Motors, I want to value Harman Audio to Tata Motors. So here's what I'm going to do. I'm going to first do my valuation entirely in US dollars. Why do you think I chose US dollars rather than Indian rupees? It's purely pragmatic. Harman Audio is a US company. All of its numbers are already in dollars. Most of its revenues are outside India. I could do it in rupees if I wanted, but that would just make my life more difficult. I'm going to do it in US dollars. Why does it matter? Because my risk-free rate will now be a USD bond rate. For the beta, I use the beta of electronic companies, not the beta of automobile companies. You see why? Same reasons we use for the Rio Disney, the theme park cost of capital, beta of electronic companies. That beta is going to play out in my cost of equity. For the equity risk premium, guess which company's operating exposure I looked at? I looked at Harman Audio's exposure, and it is 27% US, 34% Germany, 19% rest of Europe, about the remaining 19% from Asia. Weighted average, 6.13%. For the debt ratio and the cost of debt, I assume that Harman's existing debt ratio would continue because that's what they can afford to borrow. Here's a trap that many people who look at acquisitions fall into. They look at how an acquisition is all funded to actually come up with a debt ratio. And here's why that's a dangerous thing to do. Can you acquire a company entirely with debt? Sure. If I follow your reasoning that debt ratio should come from how I acquire the company, what should the cost of cap for that acquisition be? It's 100% debt with the cost of debt, which is like, what, 3%? In the case of Disney, it's 2.4%. You really want to buy a company with a 2.4% required return? So what you use on an acquisition as debt and equity is completely irrelevant. It's what the target company can carry. So in this case, that's about, it's not much debt. They're not a highly levered company. 7.39% debt to cap, about an 8% debt to equity. I use that to come up with a levered beta and a cost of equity. And overall, the dollar cost of capital for Harman Audio is 9.67%. I want to emphasize that if I hadn't told you about the acquisition, if you were analyzing just Harman Audio, your cost of capital would be 9.6. There's nothing of Tata Motors in this number, right? And there shouldn't be. Tata Motors is the acquiring company. This is the target company. This is the target company's cost of capital. To estimate my cash flows, I'm going to keep this simple because I want to make this an entire valuation exercise. I start with the operating income that Harman Audio had in the most recent year. So these were actual numbers. Harman Audio is a publicly traded company. And then I did exactly what I did in the project. To go from earnings to cash flows, what do I need to do? I need to first bring in a tax rate. Then I had to bring in capex and depreciation and working capital. But now I'm looking at the entire company, not a project. But actually, it's easier. The statement of cash flows gave me that. The cash flow that I'm going to use will reflect the 18.21% effective tax rate they paid during the year. And the capex and depreciation I pulled right off the statement of cash flow. So this is a company that is a moderate growth company that's reinvesting money. And I'm estimating what the cash flows will be after reinvestment but before debt payments. So basically, I'm staying with the pre-debt cash flow. To keep things simple, I'm going to assume that the company is in stable growth already. Why? Because otherwise I'll be putting out growth for the next 10 years. I don't want to go into that exercise. Let's say it's a mature company, growing at roughly 2.75%. That's actually my risk-free rate. We'll talk a little bit later about why that is a good proxy for growth forever. 2.75% growth. My cash flows next year are going to be about $167 million. I've got a cost of capital. I've got expected cash flows next year. I've got a growth rate. Put those numbers in. The value that I get for Harman Audio is about $2.5 billion. Expected cash flow next year divided by cost of capital minus the growth rate. I have a problem. You know what the problem is? The market cap for the company is actually about 5.4 billion. And if I use my estimated value for this company, the value that I get for the equity is 2.6 billion. If I stopped right there and say, should Tata Motors buy Harman Audio, what's your answer going to be? It's a terrible, if you take the difference, that's a net present value of minus 3 billion. But guess what you're going to run into at Tata Motors? They're going to say, but you haven't considered synergy. A little later, in the next class, I'm going to bring in synergy. It's not magic. I'm going to say, okay, tell me what the synergy is. I'm not going to let you use it as a buzzword to explain away the $3 billion negative net present value. What's the synergy? How many more cars can you sell? Where will you sell them? We will value synergy explicitly, and already you can see what synergy has to be worth for this to be a good investment. It's got to be worth more than $3 billion. And if you can show me it's there, I'll go along. But don't just tell me it's a plug variable to explain away the difference between what you pay and what something is worth. So if you think about it, we've done 4 projects, right? Disney theme park, cash flows the firm, pre-debt cash flows, cost of capital. Then we went to Disney Plus, a streaming show, and we kind of threw up our hands and we don't know what to do here because there is no explicit revenue, earnings, cash flows. It takes the form of number of subscribers. So if you're Disney Plus and you're promoting a show, you need a better way of monitoring what's happening because of the show. I think the only time I've actually been able to see this effect play out in numbers, there are 2 times. One was in the Game of Thrones, where HBO was actually reporting that the number of subscribers, based purely on, because remember, HBO at that time, this was the show. It wasn't like they had 50 shows like Netflix, right? So there, any change in the subscriber numbers came directly from the next Game of Thrones episode. The second scenario where I was able to do this was when Lionel Messi signed for Miami last year. Or was it 2 years ago? You think, what's that got to do with streaming? What's it?
Apple TV Plus does MLS coverage.
And nobody was watching it, unfortunately, because very few people. With the day when Messi played that season, it doubled the number of people who signed up. It's extra on Apple Plus. Your regular subscription doesn't cover it. It's $79.95 a year. The reason I know it so precisely is my son-in-law is a soccer fan, and this is my annual Christmas gift to him. I don't know how much he appreciates it or doesn't. It's an easy gift to find. But that signing of Messi, you could see, caused the number of subscribers to almost double that year. So does Lionel Messi have an effect? Maybe he's not the greatest soccer player anymore, but he clearly can bring in numbers into the stadiums, and it's showing up as streaming plus numbers. So no, But the problem with Netflix and Disney is there's too much stuff going on for you to isolate the effect of any show. So I'm going to stop there. I know it never end early, but I don't want to start. But next session, when we start, we're going to talk about side costs and side benefits. I would recommend that you start reading ahead that section or looking at the slides because it might help you on the Celsius Eats case because there are side costs and side benefits. I don't want to be mysterious. What's one of the big side costs of taking this project? There's that logistics investment, right? Where you run out of storage capacity earlier. Think through what it means, right? And how do we ask the question? What will happen if I take the project? What will happen if I don't take the project? Work through each and look at the difference because that's going to allow you to answer that question. So I will see you on Monday. Yep.
I reran the cost of capital for Lily. I came up with 8.90 cents.
Makes more sense, yeah. That definitely makes more sense. Take care.
So I think you answered my first question.
Yep.
I was going to ask you about the beta for the project. And based on what you said with the acquisition, we should be using the food company's beta and not trying to come up with some kind of mixed beta for the company at some point.
Why would you ever want to use a mixed beta? Give me the reasoning. There's one segment of the case where you might use a mixed beta, but everything else, there's no. So tell me what the argument is for a mixed beta.